Hey, welcome back to Fortune Forge. I've been trading for years, and I've seen something really interesting. Most traders, and I mean 90% of them, they lose money. Not because they don't know strategies, not because they don't have access to information. They lose because of one thing: their mind. Think about it. You probably know someone who trades, or maybe you trade yourself. They have a plan. They know what to do. But when the market moves, something happens. Fear kicks in, or greed takes over, and suddenly they're not following their plan anymore. Here's the thing: the strategy doesn't matter as much as you think. A simple strategy executed perfectly beats a complex strategy executed poorly every single time. So today, I'm going to break down the 6 biggest psychology and execution mistakes that make traders fail. And more importantly, I'm going to show you exactly why these happen, so you can recognize them in yourself before they destroy your account. If you're serious about trading, this video is for you. Let's go. Let's start with the first reason traders lose money: fear. Fear is the most powerful emotion in trading. It stops you from entering, it stops you from holding, it stops you from thinking clearly. Here's what I mean. You set up your trade. You have your entry point mapped out. You know exactly where to buy. But when that moment comes, something happens inside you. Your heart races. Your palms get sweaty. You think, what if I'm wrong? What if the price drops right after I enter? What if I lose money? So you wait. You wait for more confirmation. You wait for the perfect moment. But by the time you feel comfortable entering, the price has already moved 50 pips. You missed it. And now you're frustrated. You missed a winning trade because of fear. But here's the thing: fear doesn't stop at entries. It also destroys your exits. You're in a winning trade. You have $500 profit. The trade is going well. But then the price moves against you slightly, maybe 20 pips. Suddenly, fear kicks in again. You panic. You think, I'd better take this profit before it disappears. So you close the trade. You take your $500 and feel relieved. But here's what happens next. 2 hours later, that same trade reaches your target. It would have made you $2,000, but you closed it early because of fear. You left $1,500 on the table. This happens to traders every single day. Fear makes them exit winning trades too early. The real problem is this: fear makes your decisions emotional instead of logical. You have a plan. Your plan says hold until target. But fear overrides your plan. Fear makes you exit early. A professional trader understands this. They know fear will come. But they don't let fear change their plan. Their rules are stronger than their emotions. So how do you fix this? First, you need to accept that fear is normal. Every trader feels it. Even profitable traders feel fear. But the difference is they don't act on it. They follow their plan despite the fear. Second, you need to have a written plan, not just in your head. Written down, with clear entry rules and clear exit rules. That when fear comes, you look at your plan. You follow it. You don't deviate. That's execution. That's discipline. And that's what separates winners from losers. The second reason traders lose money is greed and overconfidence. Here's the thing about winning trades: when you make money, it feels good. Really good. Your confidence shoots up. You feel like you figured it out, like you're unstoppable, and that's exactly when disaster happens. Let me explain what I see all the time. A trader has a good week. Maybe they made $1,000 profit. They're excited. They think they've cracked the code. So what do? They increase their position size. Instead of trading one lot, they trade 2 lots. Instead of risking $100 per trade, they risk $300. Why? Because they're confident. They think they can't lose. They think every trade will be a winner. But the market doesn't care about your confidence. The market doesn't care about your winning streak. Then it happens. One bad trade, one loss. And because they increase their position size, that one loss wipes out all their profits from the week. Suddenly, they're back to zero. Or worse, they're in the red. This is greed working against you. Greed makes you take bigger risks when you should take smaller risks. It makes you think you're better than you actually are. It makes you forget that losing is part of trading. Here's another thing greed does. It makes you overtrade. After a win, you want another win. So you take the next trade, and the next one, and the next one. You're trading constantly. You're not waiting for quality setups anymore. You're just taking every trade that comes. This is where overconfidence kicks in. You think you can read the market so well that you can trade anything. Every setup looks good to you. Every signal looks profitable. But trading is about patience. It's about waiting for the right setup. When you're greedy and overconfident, you lose patience. You trade garbage setups, and garbage setups lose money. I've seen traders blow up entire accounts this way. They had a few wins, got greedy, increased position sizes, started overtrading, and then one market move wiped them out completely. The psychology here is simple. After a win, your brain releases dopamine. You feel good, you want that feeling again, so you chase it. You take more risk, you trade more, you want to feel that winning feeling again. But that's emotional trading. That's not professional trading. A professional trader has strict position sizing rules. No matter how confident they are, they don't change their position size. They risk the same amount on every trade. They wait for quality setups. They don't overtrade. So how do you avoid this trap? You need rules, and you need to follow them religiously. Rule 1. Your position size never changes based on how confident you feel. It's based on your account size and your risk tolerance. Period. Rule 2. You only take trades that meet your criteria. Not every trade. Not trades you feel good about. Only trades that fit your system. Rule 3. After a winning streak, you actually need to be more careful, not less careful. Because the market is about to humble you. That's the execution part. That's what stops greed from destroying your account. The third reason traders lose money is revenge trading. Revenge trading is one of the most destructive things a trader can do, and almost every trader has done it at least once. Here's what it looks like. You take a trade, it goes against you, you lose money. Maybe you lose $300. You're frustrated, you're angry, you feel like the market stole from you, so you think, I need to win that money back right now. That's revenge trading, and here's why it's so dangerous. When you're in revenge mode, you're not thinking clearly anymore. You're thinking emotionally, you're angry, you want to punish the market, you want to prove you're right. So what do? You take the next trade without waiting. You don't check if it meets your criteria, you don't have a proper plan. You just want to win money back fast. And because you're rushing, because you're emotional, you usually take a bad trade, and you lose more money. Now you've lost $300 plus another $200. You're down $500, but you're even more frustrated now, so you do it again. You take another revenge trade, and another one. Each time you're hoping to win it back. Each time you're failing. This is a downward spiral, and it's one of the fastest ways to blow up an account. Let me tell you why revenge trading happens psychologically. It's called loss aversion. Your brain hates losing money more than it enjoys winning money. A $300 loss hurts more than a $300 win feels good. So when you lose, your brain is desperate to fix it. It wants to reverse that loss immediately. It's not thinking about tomorrow or next week. It's thinking about right now. Your brain is essentially screaming, fix this now. Win that money back now. And when your brain is in that state, you make terrible decisions. You ignore your rules, you ignore your plan. You just act. I've seen traders lose their entire account this way. They had a bad trade, lost $500, then took revenge trades and lost another $2,000, all because they couldn't handle the loss psychologically. Here's another thing about revenge trading. It's a confidence killer, because now you've lost twice. You've lost your original trade money and your revenge trade money. Your confidence is shattered. You start doubting yourself. You start doubting your strategy. So you either quit trading or you take even more revenge trades trying to fix it. The cycle continues until your account is empty. So how do you stop revenge trading? You need rules, and you need to follow them when you're emotional, not just when you're calm. First rule, after a losing trade, you must wait. Don't take the next trade immediately. Wait at least 1 hour. Or even better, wait until the next day. This gives your emotions time to settle. Second rule, after a losing trade, you must review it. Ask yourself, did I follow my plan? Did this trade meet my criteria? If the answer is no, then that's good feedback. You know what went wrong. You don't need to revenge trade. Third rule, your position size after a loss should be smaller, not bigger. If you lost on a one-lot trade, your next trade should be on a half-lot. This keeps you safe while your emotions calm down. Fourth rule, you have a daily loss limit. Once you hit it, you stop trading for the day. No matter what. No revenge trades allowed. This is execution discipline. This is what separates professional traders from gamblers. They have rules for when they're emotional, and they follow those rules. Because they know that revenge trading is just emotion taking over. And emotion always loses in the long run. The fourth reason traders lose money is lack of discipline and not following their plan. Here's something interesting I've noticed. Most traders actually have a plan. They sit down, they think about their strategy, they write it down. They know their entry rules, they know their exit rules, they know their risk per trade. But here's the problem. They don't follow it. It sounds simple, but it's the biggest execution failure I see. Traders have the right plan, they just don't execute it. Let me give you an example. A trader decides their entry rule is only enter when price breaks above the previous high with volume confirmation. That's their rule. They wrote it down, but then price is approaching the previous high. It looks like it might break. The trader gets excited. He thinks this is going to be a big move. So he enters early, before the breakout even happens. Before volume confirmation, he deviated from his plan. Why did he do this? Because emotion kicked in. He got excited. He got FOMO. He didn't want to miss the move, so he broke his own rule. And usually when you break your rules, you lose money, because your rules exist for a reason. They're designed to filter out bad trades. Here's another example. A trader's exit rule is take profit at 1 to 4 risk-reward ratio. That's the plan. If he risks $100, he takes profit at $400 gain. But when the trade is up $200, he sees the price pull back slightly. He gets nervous. He thinks, what if it reverses and I lose this profit? So he closes the trade early. He takes $200 instead of waiting for $400. He deviated from his plan again. Now here's the thing. One deviation isn't catastrophic, but when you deviate over and over, it becomes a pattern, and that pattern is what destroys accounts. Because when you don't follow your plan, you're essentially saying, my plan isn't good enough. I need to make decisions based on my feelings instead. And feelings are terrible at trading. Let me tell you the psychology behind this. When you have a plan but don't follow it, there's a disconnect. Your brain knows what the plan says, but your emotions say something different. And in the moment, emotions are louder. Your brain is in fight or flight mode. It's trying to protect you from loss. It's trying to maximize your gain. It's not thinking logically, it's thinking survival. So it overrides your plan. This is why so many traders fail. Not because their plan is bad, but because they don't have the discipline to execute it. And here's the catch. Discipline is a skill. You can develop it, but most traders don't. They think discipline is something you're born with. You're not. You build it through repetition. So how do you build discipline and actually follow your plan? First, your plan needs to be crystal clear. Not vague, not flexible. Clear. Every rule should be specific. No room for interpretation. Not enter on strong signals. Say, enter when RSI crosses above 50 and price closes above 20-day moving average. Specific. Second, you need to write it down, not just remember it. Write it down, print it out. Keep it visible. Before every trade, read your plan. Remind yourself of the rules. Third, you need to accept that following your plan means sometimes missing trades. Sometimes your entry signal doesn't trigger, that's fine. You wait for the next one. You don't deviate just to get into a trade. Fourth, you need to review your trades. After each trade, ask yourself, did I follow my plan? If yes, good. If no, you know you have a discipline problem. You need to work on it. Fifth, you need to understand that your plan exists to protect you. Every rule in your plan is there because you learned it the hard way or you researched it. Your plan is smarter than your emotions. Trust it. Discipline is the difference between a plan that works and a plan that fails. Because a plan only works if you execute it. That's execution. That's what most traders are missing. The fifth reason traders lose money is impatience and overtrading. Trading requires patience. Real patience. The kind of patience where you sit and do nothing for hours. Or even days. Waiting for the right setup. But most traders don't have that patience. They get bored. They get restless. They feel like they need to be doing something. So they trade. Constantly. Here's what happens. A trader is waiting for his entry signal. He's following his plan, but nothing is triggering. Price is moving, but it's not meeting his criteria. So he waits. But after 2 hours of waiting, he gets impatient. He thinks, maybe I'm missing something. Maybe I should take this trade even though it doesn't quite fit my rules. So he enters anyway. He deviated because of impatience. And usually the trade goes against him because it wasn't a quality setup, because it didn't meet his criteria for a reason. Here's another scenario. A trader takes a trade. It's going well, but it's moving slowly. He's up $100, but his target is $400. So he needs to wait longer, but waiting is boring. He's been in this trade for 2 hours. He wants action. He wants to do something. So he closes the trade early and takes the $100. He left $300 on the table because he was impatient. This happens over and over. A trader takes 10 trades in a day. Most of them are mediocre setups because he was impatient. Most of them lose money because they weren't quality trades. But if he had waited, if he had been patient, he could have taken 2 quality trades that would have made real money. The psychology here is interesting. Your brain is wired for action. When you're a trader, you're staring at charts all day. Your brain wants stimulation. It wants you to do something. Sitting and waiting feels wrong to your brain. So your brain pushes you to trade. It tells you, come on, take this trade. Do something. Don't just sit there. This is called action bias. And it's one of the biggest killers of trader accounts. Here's another thing about overtrading. When you take too many trades, your win rate goes down. Because you're taking bad setups. You're trading noise instead of signal. And when your win rate goes down, your losses accumulate. You lose more money, you get frustrated, and you trade even more, trying to win it back. It's another downward spiral. Let me give you the numbers. A professional trader might take 5 to 10 trades per week. That's it. Quality setups only. But an impatient trader takes 5 to 10 trades per day. He's trading everything. His account gets destroyed. The difference? Patience. So how do you develop patience? How do you stop overtrading? First, you need to set a trade limit. Decide, I will take maximum 5 trades per week. That's it, no more. Even if there are more setups, I don't care. 5 trades per week. This forces you to be selective. Second, you need to have specific criteria for your trades. Really specific. Not just, this looks good. Say, I only enter when price is at support level, and RSI is below 30, and volume is above average. 3 conditions. If all 3 aren't met, no trade. Third, you need to accept that missing trades is fine. In fact, missing trades is good. It means you're being selective. It means you're waiting for quality. Fourth, you need to have something else to do while waiting. Don't stare at charts all day. Go for a walk. Read a book. Exercise. Keep your brain occupied so it doesn't push you to trade out of boredom. Fifth, you need to journal your trades. Look at your 5 best trades and your 5 worst trades. You'll notice your worst trades are usually the ones you took when you were impatient. When you didn't meet your criteria, that's your feedback. That teaches you patience. Here's the truth. Patience is a competitive advantage in trading because most traders are impatient. Most traders overtrade. Most traders lose money if you can wait, if you can be selective, if you can take only quality setups and ignore everything else. You will outperform 90% of traders. That's execution. That's discipline. That's what separates winners from losers. The 6th and final reason traders lose money is lack of self-awareness. Here's what I mean. Most traders don't know themselves. They don't know their weaknesses. They don't know their emotional triggers. They don't know why they make the mistakes they make. So they repeat the same mistakes over and over. Let me give you an example. A trader blows up his account. He loses everything. He gets angry. He blames the market. He blames bad luck. He blames his broker. But he never asks himself, why did I really lose? What did I do wrong? What are my weaknesses? So he opens a new account, and he repeats the exact same mistakes because he never figured out what he was doing wrong in the first place. This is lack of self-awareness. Here's another example. A trader notices that every time he has two winning trades in a row, the third trade is usually a loss, but he never connects the dots. He never realizes, oh, I get overconfident after wins. I start taking bad setups, so he keeps losing on the third trade after wins. Over and over. But he never changes anything because he's not self-aware enough to see the pattern. This is the problem. Without self-awareness, you're basically gambling. You're making the same mistakes on repeat. You're not learning. You're not improving. Here's the psychology behind this. Your brain doesn't like admitting mistakes. It's called the ego defense mechanism. When something goes wrong, your brain protects your ego by blaming external factors. The market was unfair. The broker manipulated me. Bad luck. But the truth is, usually I made a mistake. I deviated from my plan. I got emotional. Accepting that is hard on your ego. So most traders don't do it. They blame outside factors instead. And because they blame outside factors, they never fix the real problem. The problem is inside them. Let me tell you what self-aware traders do differently. They journal every single trade, not just the result. They write down their emotions. They write down what they were thinking. They write down if they followed their plan or deviated. Then, once a week, they review their journal. They look for patterns. They ask themselves, what went wrong this week? What emotional triggers did I have? When did I deviate from my plan? And when they find a pattern, they work on fixing it. For example, maybe they realize, I always panic sell when I'm up $100. That's my pattern. So they make a rule. When I'm up $100, I must hold for at least one more hour before closing. Or maybe they realize, I always overtrade on Mondays. I'm excited after the weekend. So they make a rule. Mondays, maximum 2 trades. This is self-awareness in action. Here's another thing self-aware traders do. They track their win rate. They track their average win size. They track their average loss size. They know their numbers. Why? Because numbers don't lie. Your emotions lie, your brain lies. But your numbers tell the truth. If your win rate is 40%, your average win is $300, and your average loss is $100, then you know you have a positive expectancy. You know you can be profitable in the long run. You just need to keep trading. But if your numbers show a negative expectancy, then you know your strategy isn't working. You need to change something. Most traders don't track these numbers, so they don't know if they're actually profitable or just getting lucky. So how do you build self-awareness? First, start journaling. Every trade. Write down your entry, your exit, your emotions, your reasoning, all of it. Second, review your journal weekly. Look for patterns. What mistakes do you repeat? When do you deviate from your plan? What are your emotional triggers? Third, track your metrics. Win rate, average win, average loss, profit factor. Know your numbers. Fourth, ask yourself hard questions. Am I really following my plan? Or am I fooling myself? Be honest. Your future profits depend on honesty right now. Fifth, when you lose, don't blame the market. Ask yourself, what did I do wrong? What can I learn? What will I do differently next time? This builds self-awareness. And self-awareness is the foundation of improvement. Here's the truth. If you don't know yourself, you can't improve. If you don't know your weaknesses, you'll keep losing money. Self-awareness isn't optional. It's essential. That's why so many traders fail, not because they're stupid, but because they lack self-awareness. They don't see their own patterns. They don't see their own mistakes. But if you commit to self-awareness, if you journal, if you review, if you track your numbers, you'll start to see things clearly. And when you see clearly, you can fix things. That's the path to consistent profitability. All right, let's wrap this up. We've covered 6 reasons why 90% of traders lose money. Let me recap them for you. Number 1. Fear-based decision-making. Fear stops you from entering trades and makes you exit too early. The fix is having a written plan and following it despite your fear. Number 2. Greed and overconfidence. After wins, traders increase position size and overtrade. They think they're unstoppable. Then one loss wipes them out. The fix is strict position sizing rules that never change. Number 3. Revenge trading. After a loss, traders try to win it back immediately. This leads to emotional, bad trades and bigger losses. The fix is waiting after a loss, reviewing it, and reducing position size until emotions settle. Number 4. No discipline and plan following. Most traders have a plan but don't execute it. They deviate based on emotions. The fix is crystal clear rules, written down, reviewed before every trade. Number 5. Impatience and overtrading. Traders can't wait for quality setups. They trade constantly and take bad setups. The fix is setting a trade limit, having strict entry criteria, and finding something else to do while waiting. Number 6. Lack of self-awareness. Traders don't know their weaknesses. They repeat the same mistakes. The fix is journaling every trade, reviewing weekly, and tracking your numbers. Here's the common theme in all 6 reasons. They're all psychology and execution problems, not strategy problems. You don't need a complex strategy to make money in trading. You need the right mindset and the discipline to execute. That's the real secret. That's what separates the 10% who succeed from the 90% who fail. If you can master your emotions, if you can follow your plan, if you can be patient and disciplined, you will make money. It's not sexy, it's not complicated, but it works. Now, I created something for you, a free psychology guide that breaks down these concepts even deeper. It includes exercises, journaling templates, and specific rules you can use right now. You can grab it for free. The link is in the description. Just enter your email and I'll send it to you. This guide will help you start building self-awareness immediately. You can start journaling today. You can start tracking your numbers today. You can start fixing these psychology problems today. If you found this video helpful, please hit the like button and subscribe to the channel because we're going to keep diving deep into trading psychology and execution. That's what Fortune Forge is all about. Thanks for watching.